Thank you for joining us, Mr. Jeffrey Christian. We met at the Bloomberg Precious Metals Conference a couple of weeks ago.
Yes.
And we listened to your speech during the conference, and you're kind of controversial, but you're on the other side of the whole opinions, bear versus bullish, liquidity versus no liquidity. Right. So taking today's data into consideration, also this week's data into consideration from China, from Europe, gold slides on PMI fears, right? Yeah. Are we going to see more slides throughout the year? What do you expect?
You know, our expectation has been that investors would back away from buying as much gold as they have over the last few years because they would realize that the economic problems are not catastrophic, but rather long-term ongoing problems. And I think that that's what we're seeing. We had thought that the gold price would peak in 2011. It looks like it has peaked. We do expect prices to come off over the next several years, and we do expect prices to be lower at the end of the year than they are today.
So in your book, I want to show to our audience, which is the CPM Gold Yearbook 2012.
Yes.
And it's coming out on Tuesday next week.
Yes.
We cannot say anything about it yet, but we can have some outlook. What's interesting in this book? What is very attractive to the investors, to your clients?
Right. Well, I think there are two things. One is that these books always present the best data available on gold investment demand, central bank purchases, mine production, scrap recovery, fabrication demand, and the market in general. So they always provide investors a lot of really hardcore, real data that's reliable in a gold market that is overrun with misstatements and misinformation and a lot of speculation. So I think that, you know, from an investor's perspective, just getting that basic data and basic analysis is really good. In addition to this year, you know, we talk about the idea that we probably are at or slightly past a cyclical peak in the gold price, but that we don't expect gold prices to fall that sharply. We don't expect them to go back to $1,000 or anything like that.
Where do you expect it to go?
We wouldn't be surprised to see the gold price trade between, say, $1,400 and $1,600 over the next couple years, and then rise beyond 2014, 2015. And we lay out the economic and financial reasons why we think that that's the most likely scenario. And I think that's probably really important for investors to understand.
And let's talk about the demand, the investment demand. Is it out there?
There is a lot of investment demand, and most investors, it's very important, most investors buy gold as a long-term asset. They buy it and they rarely sell it. So they buy more gold when they're extremely concerned about economic and financial stability, as was the case in July, August, September of last year, and they buy less gold when they're less concerned. So in the 1990s, they were buying 10, 15 million ounces of gold a year. These days, they're buying 30, 34 million ounces of gold a year. Investors have bought more gold in the last decade than they had bought in the 5,000 years to 1965. So investors have been buying a lot of gold. They're backing away a little, but most of these investors are long-term investors. You have some shorter-term investors who have been getting out of the market since September. But what's happening is, as those short-term investors get out of the market, they've driven the price down from $1,920 to $1,620 today. And the longer-term investors are saying, okay, $1,620 is a lot more appetizing to me than $1,920. So what we've seen since September is every time the short-term investors get out and drive the price down by exiting the market, the longer-term investors have been taking that as an opportunity to buy gold. And that's what's happening this week.
There's another buyer, you know, talking about the buyers, there's another buyer in the market, which is the central banks.
Right.
Instead of selling, they've been buying. And what's their intention?
Well, you know, if you look at it, the central banks that sold gold, 14 million ounces a year from the 1980s through the 1990s into a couple years ago, were the industrialized economies that had built up massive gold reserves as a result that they were powerful economies during the gold standard days. And they were selling gold that they had built up during the gold standard days. They've pretty much sold all the gold they want to sell, so they've stopped selling. And on the other side, you have the emerging economies, which have this massive influx of foreign exchange because they're massive exporters. They are running big surpluses, current account surpluses and trade surpluses. And most of the money coming into their countries are dollars and euros. So they're seeking to diversify their monetary reserves by sterilizing some of that monthly regular inflow of dollars and euros, buying gold. The problem is the gold market's too small for it to be a wholesale conversion of dollars and euros to gold. So they can only buy a little bit of gold compared to the dollars flowing in.
Others think that the market is not that small. And they also expressed their opinions during the conference. What do you say to that?
Well, it's interesting. I mean, I was talking to an institutional investor last week, and he said, he expressed that no one wants to hold dollars anymore. And I just threw out two facts. I said, you know, you have about 1.2 billion ounces of gold held by investors. That's worth about $2 trillion at today's price, a little bit less than $2 trillion. You have $65 trillion held by investors, private sector investors worldwide, in dollars and euros and currencies. So you have 33 times as much money going into currencies as you do into gold. And I think one of the mistakes that gold investors and gold true believers do is they think that there's this wholesale migration from dollars to gold, but it's really a marginal shift. I mean, fewer than 1% of the investors in the United States and Europe invest in gold. And that's always going to be the case. The gold bulls say, well, the other 99% haven't yet bought. My comment is, if you haven't bought gold over the last decade, with everything that's gone wrong in the world, and you haven't bought gold at 270 or 300 or 500 or 700 or 1,000, you're probably not going to buy gold.
So you're saying history repeats?
History repeats itself. And this is a marginal market compared to currencies.
And in your book, you said you also talked about the gold mining, the production.
Yes.
We are seeing a growing production in gold. Are we going to keep seeing that? And why is it growing? Do you talk about that in your book?
Yes, we talk. We give a lot of details. You know, gold mine production doubled from 1980 to 1999 as a result of the increase in gold prices in 79, 80. From 99 until about 2006, it contracted because gold prices had gotten down below $320. Now gold prices are $1,600. They're down to $1,600. At $1,600, the average mining company in the world that's mining gold at $1,600 is making $1,000 an ounce profit. So, you know, it's 150% profit margin on a $600 product. And as a result, you see people working very hard to develop gold mines. It took a long time because of constraints in developing gold mines to see the price reaction, but over the last 3 years you've seen world mine production grow at about 2.5% per annum. And you have this pipeline of hundreds of projects that are now under development that will probably continue to bring mine production on stream over the next several years. We expect over the next several years about 20 million ounces of new capacity to come on stream.
Yes, okay. Last 10 seconds, you know, there's a lag between the rising gold prices and the stock performance of the gold mining companies. Other than the operating costs that they've been saying, what are the reasons?
Well, there are a lot of reasons. One is that a lot of investors have been disenchanted with gold mining companies' management and performance. Another one is that you had easy money to be made by buying gold when the gold price was rising. If we're right and the gold price has plateaued, and it doesn't necessarily fall sharply, but it stays high, those mining companies should become very attractive because they'll be very profitable, and they should be kicking off dividends.
Thank you so much for joining us. Thank you.